think we're going to see a cataclysmic move higher in bond yields. Yes, that's what gold is telling us. There's fear of default, fear of currency collapse. There's fear of conflict as well, of course. We've seen Xi Jinping, FT is reporting this morning, Xi hails unstoppable China at landmark military parade with Putin and Kim. Wednesday, September 3rd, 2025, Maneco 64, home of alternative economics and contrarian views. Hopefully, most of you know why gold and silver are surging to new highs. Well, at least gold over 3,500 in the spot price. Silver reaching 14 or 15-year highs, very close to the all-time high of 50, which I think will be broken very easily. But I think in general there are a lot of questions out there, and what I think we're seeing is a culmination of the end of a reckless period in which central bankers thought they could change actually thousands of years of history. Yes, thousands of years. And I made a video back in July when I was in Switzerland entitled "We Are in Once in the Millennium Monetary Event," and I'm gonna increase that to like recorded history actually, and I'm gonna show you why by referring you to a really good book about interest. Yeah, that's what I'm seeing right now. And why do I think, well, I think we're very close to the end of this reckless experiment by central planners, people like Bernanke and others, right? It's not just Bernanke, but central bankers throughout the West, the major central banks. They've been at this zero rate, artificial interest rate policy, really even before '08. They've been pushing for that. And from '08 to like 2020, rates were kept at zero for, yeah, basically for 12 years. And in some countries, government bonds, especially in the longer end, their yields went negative. And at the time, I kept saying this is a massive bubble. And the reason fund managers and speculators were buying these bonds, even though their yields were negative, is that the more of a longer term bond you have, the higher the prices move, the sharper the prices move higher when the yields go down. So it became like a speculative bubble instead of being bonds being fixed income, right? Boring fixed income. And by 2019, there were $17 trillion worth of government bonds that were negative, had a negative yield. So I'm going to show you a chart here, and I'm going to tell you about the book now. It's The Price of Time, The Real Story of Interest by Edward Chancellor. I think I've recommended this book before. I'm sure I have. And it's a great book. We're going to come to it in a minute. Let's see, it was published only 3 years ago, 2022. But I took a liberty of taking a photo of a chart in the book. I could have shown it to you, but it's easier to put it on the screen so you can see now. 5 millennia of interest rates. Rates were never really below 3%. Yes, they were a lot higher, let's say 3000 BC. They came off. But notice how they pretty much stayed between 3 and 6%. Yet there were some spikes there in the 1800s. You can see that rate spiked to 9%. But on average, we've been between 3 and 6. I'm finishing reading this book right now, The Count of Monte Cristo. Of course, I've seen the movie many times, but I wanted to read the book, and it's amazing how they talk a lot about money in this book, of course, because the Count was wealthy beyond all imagination, right? And there were a lot of other wealthy people in the book, and they talk about, oh, he earned so much a year. And you can do the calculation, it's usually 5%. So 5% has been, on average, a decent return for loaning out your capital, a decent return considering all the risks. But as you can see, since World War One, we've had a massive intervention and artificial construct of interest rates. Notice that prior to 1930, rates went down to zero. And what was that, in my opinion? Well, that was back in the mid-20s when Britain went back on the gold standard at really not the right rate, because they had printed loads of money during World War One. And then Chancellor of the Exchequer, Winston Churchill, decided to go back on the gold standard at the same rate that Britain had prior to World War One, and that didn't work. So what happened there is that the New York Fed, under the leadership of Benjamin Strong, who was a very good friend of Montague Norman, the governor of the Bank of England, he kept rates really low. He cut rates in order to help sterling at the time. Sterling was the major reserve currency. That, of course, led to the stock market bubble that we saw. It burst in 1929. And then we had World War One as well. There was World War Two, yield curve control in the U.S. And, well, that, of course, led to the spike in interest rates in 1981. And I would venture to say that all the manipulation that we had in the post-World War One period was unwound in 1981. But it doesn't seem like we've learned the lesson, and interest rates went down again. We stayed at zero for over 10 years, and now I think we're going to see a cataclysmic move higher in bond yields. Yes, that's what gold is telling us. There's fear of default, fear of currency collapse. There's fear of conflict as well, of course. We've seen Xi Jinping, FT is reporting this morning, Xi hails unstoppable China at landmark military parade with Putin and Kim. We saw earlier this week and on the weekend this SCO conference where even India is getting together with these major powers in the BRICS. They're calling it a new world order. So it's clearly a challenge to the West. And am I saying there's going to be war? I don't know, but some kind of conflict, I think we will see, because the current major hegemon, the United States, is not going to go down lightly, in my opinion. And this is not taking sides. I'm just trying to tell you what I'm seeing. But back to the markets. So some of you have written to me on Patreon and asked about Japan, that I haven't been covering too much, the Japanese carry trade. Well, I have actually. I even have a playlist for it, so you can look for my playlist, the Japanese yen carry trade. But the reason I'm talking about Japan is Japan has been, and its central bank and government, Ministry of Finance, they've been the pioneers in this mad, reckless experiment of artificial low rates in order to fight deflation, right? And yeah, Japan was one of those countries that had trillions of dollars of negative yielding bonds up until recently, actually, not just 2019, up until 2020, 21, 22. But now, as you can see here, the 30-year Japanese government bond is at all-time highs. It's at 328, and you might think, well, that's below that 5% average you spoke about. Maybe so, but as you can see here, up until the end of 2021, that 30-year yield was below 1. Back in 2019, which I spoke about, the 19 trillion, the yield on the 30-year was minus 0.13. So it's a huge move, and it looks like it's not going to stop. The move is on. It's unstoppable. The Bank of Japan, of course, has been one of the major culprits for this, because the way they kept interest rates low and drove it negative was with QE, basically creating reserves out of thin air, or reserve money, if you want to call it, and buying those bonds. But they have to stop sometime, because if you keep doing that, the currency will collapse even more. The Japanese yen is one of the currencies that's collapsed the most versus gold. I think it was at 60, 1 ounce was 60,000 back in '08. Yesterday we were trading at 520,000. So they're really between a rock and a hard place. And Japan, the carry trade has been a big source of liquidity for the rest of the world. But now, with the bond markets going down the drain, especially in the longer end, people are having to unwind that carry trade. And what is the carry trade? Well, speculators, investors everywhere around the world, they had been borrowing in yen because it was really cheap. It was artificially low rates. But now they're having to refinance those borrowings, and yeah, they can't afford it anymore. And they, of course, borrowed to buy higher yielding assets. And that's why this is so serious, because not only are they getting higher borrowing costs, they're having to liquidate higher yielding assets, stocks, bonds, whatever else, real estate. It's a cocktail for disaster. And the rest of the world is going the same way. We saw yesterday the 30-year yield in the US approach 5%. Well, right now we're at 4.99. The key level there is 5.16. In Germany as well, the 30-year there has reached levels we haven't seen in like 15 years. In the UK, we reached levels we haven't seen since 1998. So that's what's going on. The problem with these rising yields and falling bond prices is that the geniuses that run our financial system, the regulators, the central bankers, the politicians, investment managers, they think that government bonds are safe. So for decades, they've encouraged investors to have a 60-40 portfolio. What does that mean? Well, 60% equity, 40% government bonds. And no gold, of course. But the other problem is that major financial institutions like banks, insurance companies, pension funds, they hold trillions of dollars of these government bonds, especially longer end. Why longer end? Because they have higher yields, and they have a lot of liabilities, like they have to pay to people who pay into these schemes or invest with institutions. But now we're seeing that even the Dutch pension fund managers, they're moving, I think, a few hundred billion worth of euro investments in longer term government bonds, not just Dutch, but all government bonds around the world. to the short end because they see the writing on the wall. So I think that's what's going on. That's why gold is surging. And yes, there is greed out there, but I think the move in gold higher has all to do with fear. Fear of government bond collapse, a sovereign government bond sovereign debt crisis. And this is going to be big because this is not just Portugal, Italy, Ireland, Greece, and Spain. This is the United States, Japan, Great Britain, Germany, France. This is huge. And yes, and added to that, you got countries like China and Russia flexing their muscles, moving away from our financial system, buying more and more gold. So my hope is that if you've been watching me for the last 10 years or the last few years, you've prepared yourself by being outside the system as much as possible. And granted, I'm inside the system somewhat with my mining stocks investments. But yeah, you need to have gold and silver outside the system. So the book here, The Price of Time, and Edward Chancellor, he warns about this, and that's why he put that chart there, just to show that this experiment is really reckless. And I think it's a really timely warning. 2022, that's when the bond bear market really took off, and we're still in it and not finished at all. So James Grant from Grant's Interest Rate Observer says this about the book, and I quote, "Interest rates haven't simply fallen, they were pushed. And by their pushing, the world's central banks have constructed the hall of mirrors in which every investor has become of necessity a speculator." So argues Edward Chancellor in this brilliant chronicle of the most important prices in capitalism. You must read it. It is a masterpiece of history analysis and properly understated outrage. Yeah, the outrage is this reckless experiment that they've conducted for the last almost 3 decades with interest rates. Let's have a look at the markets then. It's 7:20 a.m. London time. Let's start with the bond market. As I said, the Japanese 30-year JGB yield is at almost 330. It's an all-time high. The US 30-year yield is just below 5%. It's at 4.99. The key level above 5% is 5.16. That's a recent high earlier this year, I think. Keep an eye on that. What about gold? What's gold doing this morning? Well, right now the spot price is unchanged, 35.33. High's been 48, and the low's been 25. Silver, yeah, it got hammered yesterday a little bit, down to like just above 40, the spot price, but it rebounded well. Didn't do as well as gold, but I think it's still okay. We're at 40.76 right now, down about 11 cents. The high overnight has been 40.99. So that's an interesting level, isn't it? And this is not just a dollar problem. This is a problem for all fiat currencies. We saw yesterday and today the price of gold making all-time highs in terms of British pound. We're at 26.40 right now. And the previous high in April was 26.09 or 26.10. So we've definitively broken out of that consolidation. There was still some doubt after the breakout on Friday, but I think the price action we've seen in the last few days is very positive for gold and silver, very bearish for the fiat system. So with that, I'm going to wish you all a very good day. Take care. Bye.